John, good to see you. Today we are talking through 4 tips for investing during a recession. Recent market volatility, inflation, interest rate hikes, all in the headlines. We wanted to walk through a few tips for investing during any market downturn. The first one is kind of a question. Is cash really king? Are you recommending that people invest a larger portion of their portfolio to cash?
Not necessarily, Erin. We really utilize a long-term strategic approach here. So I'm certainly not suggesting that clients sell their holdings to raise cash in their portfolio because, if you sell now, how do you know when the market's going to come back? So we want that strategic approach where we stay fully invested. However, with a recession, we tend to see higher unemployment rates. And when you become unemployed, you obviously have no more income coming in. So I am recommending that folks make sure they have 6, if they can, months or even 12 months of income in a savings account so that
Mhm.
should they lose their job, they can continue to pay the bills. Unfortunately, right now, banks are still paying very, very low rates on their savings for the most part. So we spend a lot of time helping clients look for higher yield savings accounts. They're mostly online, but that's okay. You get a higher yield savings account, which right now is, they're 4 to 5%,
Mhm.
which is a far cry from the 0.5% they might be getting at their local bank.
Right, right. Good point. Next, I want to talk about defensive stocks. So these are things like healthcare, utilities, consumer staples like food and beverages, generally recession proof.
They are generally recession proof. If you think about a recession where folks are potentially losing their jobs or making less money or just are more concerned, what do they do less of? They take less vacations. They go out to dinner less. They may put
Mhm.
off buying a new car, right? So those discretionary expenses that we have, we're going to cut back on. But we still need to go to the doctor. We still need to um, buy energy for to heat our homes. We still need to get electricity. So these defensive names that we're still going to be spending money on, and they're not a bad place to be in a recessionary environment.
Mhm. Okay. Next, I want to talk about dividend stocks and fixed income investments like bonds.
Absolutely. So if you think about what happens, and this dovetails a little bit to what we just talked about for a second, if you think about what companies do well and what companies don't do well in a recession, it's those high growth companies that aren't going to do well because people have pulled back and they're staying home, they're spending less, they're spending more on those staple type things. Well, if you think about it, those types of companies also are typically companies that pay higher dividends, right? So they're going to be a little bit slower grower, but they're going to pay that dividend back to their shareholders. And of course, fixed income, those are your corporate bonds or your treasury bonds. Those are nice things to have. They're going to have less volatility typically than stocks, yet they're going to pay you some income while you hold them until such time as you go back into the more aggressive posturing in the stock
Mhm.
market.
And last, even during downturns or especially during downturns, keep investing. That is known as dollar cost averaging.
Oh, absolutely. Absolutely. We know that the stock market over the long term goes up, but it doesn't go up in a straight line, right? It's quite jagged as we watch it increase over time. So if you keep investing, and the more frequently you do it, the better. Keep investing either, weekly if you can, or if not monthly. Every time you put that money in, you're going in at a price point, if you will, right? When the markets come down, if you're buying here, but you know it's going to go up, now you're buying low and you're taking advantage of these dips, and they show analysis shows that if you do that over time, you're going to take advantage of more of those dips. You're going to have a lower overall cost basis, which means you're going to have a higher overall return.
Hmm. Hmm. And I just want to underscore what we've said many times. It's just so important not to react emotionally and stay the course. These are some tips that you wanted to recommend. Of course, keep calm, don't try to time the market, avoid panic selling, and stay the course.
Avoid that panic selling and stay the course. If you just think about it from a human psychology perspective, Aaron, what happens as we see the markets going down, as you see your holdings decreasing in value, you get more concerned, you get distraught until a certain point in time you say, I can't take this emotionally anymore.
Hmm.
Let me sell out. What have you just done? You sold at a low level. And then you watch your former holdings or the market continue to do better. And you're like, oh my gosh, we're seeing it do better. I have a little bit more confidence. And then you get nervous. Oh, now I'm missing out. Let me invest back in. What have you done? You've sold low and you bought high, which is opposite of what you want to do. Had you just stayed the course, you would have ridden through that bottom and you would have found yourself in a better place.
Hmm.
So don't worry. If you have a long-term strategic plan, it's going to work. The markets have been the biggest and greatest creator of wealth in history, and they will continue to be so, but you cannot time them. Stay
Hmm.
the course and be patient.
The important part is having that plan, though, so that you can stick with it. Sean, if somebody wants to design that plan with you, what's the best way to reach you?
Oh gosh, give us a ring right here at the office. That number is 603-715-2335. Or you can hit our website, which is daviswealthmgmt.com. There's a lot of information there, a lot of things that we talk about. But if you want to book a meeting, click contact us and you can put some time right on my calendar.
All right, Sean, thank you.
Thanks, Erin.